Welcome back Thursday morning in Squawk Asia. Concerns about higher inflation in Asia have dominated sentiment over the past couple of weeks as fears grow that policymakers out here, including in India, Indonesia, also China, are falling behind the curve. Now, our next guest says that higher interest rates are not necessarily the most effective weapon against inflation. What is? Let's talk to Tony Nash, Global Director of Custom Research at the Economist Intelligence Unit. Tony, great to see you. Thanks for dropping by. So, if not rates, well, wait, let's back up. What's wrong with rates?
Some of the rates have changed too slowly. So if you look at Indonesia and some of the inflation fighting that's happened in Indonesia, the rate changes have happened quite late. Compared to some of the other locations.
I mean, timing aside, though, I mean, rates as a policy tool, what's wrong with that? Why is that not enough?
Right. Well, we see inflation in Asia, at least, as more of a supply-demand issue, really, than rates or currencies to some extent, although Singapore fights inflation through currency. Yeah. But when you look at some of the supply shocks, say, from the Australian floods or from, say, wheat out of Russia, or even Chinese farmers hoarding cotton, those are supply shocks. On the demand side, you have urbanization and rapid growth of incomes in places like China and India. So some of these are factors that really are pushing ahead no matter what happens with interest rates.
When you look at China, it has moved on interest rates, but it's also brought about other policies, anti-hoarding, trying to bring more supply into the market for commodities. Do you think those steps are adequate enough, or is there more even China could be doing?
I think until the currency is liberalized and there's appreciation in the currency, I think there's kind of a limited amount that they can do because the domestic economy really is growing.
So that's the gap in their policy step, as you see, is currency appreciation.
It's one of the gaps. I mean, real interest rates in China are negative, so there's really no incentive for people to save. So you go and you speculate on stocks or a house or you buy a new car or something like that. It's really better use of that money than putting it into a bank account.
Right. The other way of looking at that statement is that do you get the sense that China is running out of options? It's tried just about everything else, and people are saying that look, you got the renminbi just sitting there, man, use it.
Yeah, I think there are plenty of options out there. I think it's just the rate at which they make those options. I think China doesn't want to shock its economy. It sees itself now as a driver of the global economy, along with the U.S. and Europe and a few other places. So they don't want to shock their economy, and they understand the risks of, say, pricking the real estate bubble or pricking some of these other activities going out there. One of the real concerns is around producer prices, and you're now seeing the second wave effects of inflation. So I think something like 3/4 of Chinese producers said last year that they had to raise their prices in order to deal with inflationary shocks. So wages in China will go up by 11% this year, Indonesia 12%, or Vietnam 12%, Indonesia 11%. We're seeing this all around the region.
The ripple effect, isn't it? This week China would have us believe that inflation is in control, it is in check, but it did tweak those statistics. Is there a risk that inflation around,
Here's the thing, this really gets to me. People talk about lies, damned lies, and statistics, and China goes, well, look, everybody's worried about inflation in China. Well, look, what we're going to do is the weighting of food in the CPI as a part of the basket is not a 30 anymore, it's 25%. We've lowered it, so, okay, inflation comes in below that 5% handle, we're all right.
I mean, because China's eating less?
It's not doing itself any favors in terms of when it already has a history of having unreliable statistics when, 1 + 2 = 5.
Right. I think, there still is transparency on food price inflation. Food price inflation was 10% last month. And when you look at, as a country develops, the amount that people spend on food is lower as a share of their overall spend. So I think maybe they're looking ahead to that. Headline inflation was still almost 5%, about 5% in China. But if you look at a place like Indonesia, where you say China is 25%, Indonesia is about 50%. Food is about 50% of household spend. So you'll see bigger effects in Indonesia than you will even in, say, urban China and Hong Kong and Singapore.
How global is the inflation threat, Tony? Because yesterday we saw the data, PPI at the core. You were talking about wholesale prices earlier, rising at its fastest pace in more than 2 years. We were in this deflationary environment. Is it starting to build now in the more developed markets?
Well, I think UK inflation was 4% in January, right? That was largely a result of a depreciating pound. So some of these external effects of commodities are creeping into the UK economy. You have headline inflation of about 1.2% in the US. So it's not really creeping in, and Bernanke has actually received some criticism from the U.S. Congress about kind of exporting inflation, about the effects of QE hitting other markets.
Okay, we much appreciate your time this morning. Marty and I have been very hot under the collar about this Chinese tweaking of the stats, so thanks for giving us a rational perspective. Much appreciated. Tony Nash from Economist Intelligence Unit. And let's get over to Bernie Lowe in Hong Kong for the lowdown. Good morning, Bernie.